Hello everybody, and welcome to Galliford Try's full year results for the period ending June 25. I'm Bill Hocking, Chief Exec, and I'm here with Chris Hampson, CFO. Here's the agenda for today. The photo you see here is of Guildford Crescent, our first PRS or build to rent scheme down in Cardiff, and we'll come back to this as a case study a bit further on in the presentation. We've had another really good year, with revenue up 6% at £1.9 billion. I'm very pleased to report that we've achieved a divisional operating margin of 3%, 1 year earlier than our strategy envisaged, and with adjusted PBT up 28.6% to £45 million. A really good performance ahead of expectations, which produces earnings per share of 34.4 pence and a total dividend for the year of 19 pence, which is made up of the half-year dividend of 5.5p and a final dividend of 13.5p. Cash performance was excellent, with average month-end cash of £179 million, up 15% on the same period last year, and whilst paying our supply chain in 26 days on average. On the back of this performance, we're announcing a further share buyback of £10 million. Our strong order book stands at £4.1 billion, up £300 million on the same period last year, with 93% repeat clients and 92% work already secured for the current year. These figures are a reflection of the 4,300 excellent people in Galliford Try, our culture, robust risk management and performance on the ground. The continuing momentum that we see in the business and in our chosen sectors gives us confidence in the outlook for the business. So you can see from our results that we're making good progress towards our 2030 targets of at least £2.2 billion of revenue and 4% operating margin, and really pleased with our 3% operating margin 1 year ahead of programme. So those are the highlights, and over to Chris for more detail on the numbers.
Thank you, Bill, and good morning, everybody. It is amazing how quickly my first year at Galliford Try has passed, and I'm delighted to be able to take you through a second set of annual results. In the image on this slide, you can see maintenance work being carried out on a control panel by a colleague from our AVRS business. The fostering of our high-margin specialist businesses is a key objective in achieving our strategic goals, and Bill will talk you through the 4 key building blocks to our 2030 targets later. So let me first take you through the numbers for 2025 in more detail. We are pleased to deliver another strong set of results, with the group growing revenues by 6.3% to more than £1,875 million, with good growth across both our core divisions of building and infrastructure. The revenue performance in the second half continued the theme of the first half, with the very strong run-off of AMP7 continuing and with progress on our highways projects being boosted by the drier winter and spring. Alongside the 27% revenue growth in 2024, this means we've grown by more than a third in 2 years, with a CAGR of 14% since 2021. This accelerated growth is ahead of our trajectory to our 2030 targets, with an anticipated slight flattening in 2026 as we transition from AMP7 to AMP8. This transition will allow us to access the higher volumes that can be seen in our record infrastructure order book, with more to come as AMP8 scales up. 2026 expectations remain ahead of our strategic targets, and 2027 and 28 are looking really good, as Bill will explain later. Adjusted operating profit rose faster than revenue, up circa £10 million to £40.6 million, and representing an increase of more than a third. This was driven by our disciplined execution of our robust risk management model and on-time delivery of high-quality construction projects. Net interest received was £4.4 million, down £1.8 million, reflecting the non-repeat of corporation tax interest of £0.8 million in the prior year and RCF implementation costs of £500,000 in 2025. Underlying interest was down slightly, therefore, reflecting lower PPP interest, higher IFRS 16 interest costs on our growing business, partially offset by interest on higher cash balances. Adjusted profit before tax therefore increased by 28.6% to £45 million, more than doubling in the last 2 years and a CAGR of some 50% since 2021. This year's adjusted effective tax rate of 23.9% benefited from deferred tax asset increases, and we expect the rate to revert towards UK's standardised corporation tax rates in future years. The growth in profits drives adjusted basic earnings per share up by circa 16% to 34.4 pence per share, more than doubling 2022 adjusted EPS. Alongside these very strong results, we are pleased to announce a final dividend for the year of 13.5 pence per share, bringing the full year dividend to 19 pence per share, up 22.6% on the previous year, and in line with our full year dividend policy of 1.8 times cover. Based on our strong performance, we are also pleased to announce a share buyback of up to £10 million, reflecting this year's strong performance, our record order book, and confidence in our trajectory and cash generation to 2030. Moving on now to the segmental analysis, we can see strong revenue generation in our core divisions of building and infrastructure and further profit growth across all the divisions. We are particularly encouraged by the 42 basis point margin improvement in divisional adjusted operating margin to 3%, delivering our previously announced 3% margin target 1 year early. The improved margin, continuing the trend of the last few years, alongside the transition to higher margin AMP8 in the current year, gives us confidence in delivering further margin and profit growth in 2026 as we make further progress towards our 2030 4% margin target. Moving on to the investment business, Bill will shortly outline the positive progress we are making here. As we've said before, this business is lumpy by nature, and the prior year included the financial close of our first private rental scheme at Galliford Crescent in Cardiff. Through careful management, the investment business net losses were reduced to £0.4 million, and group overhead costs are up in line with revenue, largely reflecting inflationary impacts and long-term incentive costs. We are reporting a non-cash prior year adjustment following a technical change to the group's application of IFRS 15 contract combination accounting on a handful of acquired water frameworks, with the resulting associated reclassification of material losses on one of these frameworks of circa £11.7 million as an exceptional cost in the prior year. Under the application of our existing audited IFRS 15 combination policy, the group had previously combined some contracts within these specific water framework agreements, which has subsequently been deemed to be incorrect, and as a result, the group has restated reported statutory profit before tax and associated tax and working capital items in the 2024 financial statements, reducing revenue and increasing cost of sales by £11.7 million in aggregate. Following the change in IFRS 15 application, management have reviewed and are now reporting material historical project losses as an exceptional item under one framework agreement that had previously been combined within the framework as we would otherwise have done. This specific framework, which was acquired with the NMCN Water Division acquisition in 2021, with highly unsustainable terms and conditions, was positively renegotiated in 2023 and subsequent projects are now trading profitably. Importantly, no restatement has been made to the previously reported adjusted PBT in 2024 or earlier periods, and no exceptional losses have been reported in 2025, reflecting the improved performance on these frameworks. The NMCN frameworks and associated subsidiaries were acquired for £1 million in October 2021 out of administration. Since the acquisition of NMCN, revenues of more than £750 million have been delivered, and given its strong market positioning and long-term water contract relationships, the group is forecasting further revenues of more than £1.5 billion on the acquired NMCN businesses through the strategy period to 2030. Margins are in line with target trajectory, and the business is performing ahead of the pre-acquisition investment case. We've added 2 new slides this year to give you more of an insight into our core divisions of building and infrastructure and to demonstrate the progress they are making over time. Building increased revenues to circa £965 million, with consistent demand in the education, custodial and defence sectors. The record order book, diversified across our chosen sectors, is prudently measured at £2.4 billion. The order book is up more than 7% on a year ago, and the division is well placed for 2026 with 92% of work secured. The pipeline of new works can be seen in the defence project at RAF Digby, and we've also had significant wins in custodial at HMP Moorland and HMP Wakefield. Profit performance has been very strong, with margins rising 36 basis points to 2.9% for the full year, resulting in adjusted operating profit up 17% or circa £4 million to more than £28 million. An excellent performance with more to come. Moving on to our infrastructure division, which comprises our highways business and our environment business, including our higher margin specialist and capital maintenance businesses, revenue grew by circa 11% to more than £902 million. A robust performance from our highways business, as can be seen in the images of our projects in Carlisle and on the A47, and an excellent run-off result from AMP7 were the drivers of the growth. The record forward-looking order book is up more than 9% to nearly £1.7 billion, reflecting both the early strength of the AMP8 frameworks and progress in our specialist services businesses. The transition to AMP8 is in progress, with good new design work coming through, which will convert into construction work in the coming years. In highways, we've had good contract wins such as the Banwell Bypass in North Somerset, and we have expanded our entry into the energy sector with our place on the civil engineering lot of the National Grid £59 billion high voltage framework. Overall, the division delivered very strong profits, with margins up 50 basis points to just over 3%, driven by improved operational delivery and operational leverage. The division delivered adjusted operating profits of £27.4 million, up £7.3 million or circa 36% versus 2024. Another great result. Moving on to the balance sheet, the strong trading profits and continued discipline in balance sheet management have driven uplifts in both net assets and cash. Year-end cash rises from £227 million to £237 million. More importantly, average month-end cash rises to more than £178 million, from £155 million in the prior year, up nearly 15%, demonstrating our continued robust focus on cash delivery each and every month. In the second half, HMRC advanced our quarterly VAT payments, reverting to a historic pre-COVID pattern. The change meant circa £17 million of VAT payments previously scheduled for 2026 were made in 2025, as you will see on the upcoming cash bridge. This change has no impact on the overall amount of VAT cash flows. Making payments in earlier months causes a technical reduction in the average cash metric of circa £8 million in 2025, already included in the average shown for the year, and will cause a further £18 million reduction in the average cash KPI in 2026. The rebased 2025 average cash metric would therefore have been circa £161 million if the pattern change had occurred before the start of the financial year 2025. This technical KP impact, as further explained in the appendices, has no impact on the proven cash generating ability of the group. Our public-private partnership portfolio valuations have reduced as a result of the higher interest environment on our discount rates and expected loan repayments. There remains a strong secondary market for such assets, and the annuity income of £3.6 million continues to provide a stable, lower risk cash income within our trading profits. Under our current strategy, our intention is to hold on to these assets for the foreseeable future, as they provide a recognised differentiator in the strength of our balance sheet. Further, the low-risk PPP interest is given back to shareholders in full each year and supports our dividend policy of profits giving 1.8 times dividend cover. We continue to have no drawn bank debt and no pension liabilities, and our strong trading and cash management means our balance sheet has been strengthened even further. This chart explains the movement in year-end cash and cash equivalents, which have risen sequentially by circa £10 million to £237 million. Operating profits have converted like for like into cash from operating activities, and tight cash management has driven a small £2 million outflow in working capital, alongside the aforementioned VAT phasing impact. On the 14th of August 2024, we received the cash for the prior year corporation tax refund accrual of £10.4 million and returned that cash to our shareholders through the completed £10 million share buyback. We returned £17.5 million to our shareholders through our progressive dividend policy. Pleasingly, we have therefore returned a total of £27.5 million of cash to shareholders in the financial period. The net of tax, interest and other items delivered a net inflow of £1.7 million. Finally, our high-quality supply base is of key importance to us, and we continue to pay our suppliers promptly, with an average days to pay of 26 days, flat to the prior year, and we are pleased to be one of the first bronze members of the new Fair Payment Code. As we progress through the 2026 financial year, our focus on balance sheet strength and allocating our capital most efficiently remain unchanged. We have long been clear that strength of our balance sheet provides competitive advantage, which helps to deliver our sustainable growth plans. It is valuable to our clients who see the importance of financial stability, and it ensures that we are the partner of choice for our supply chain, and it is evermore a differentiator in recruiting the best colleagues. Our balance sheet also allows us to invest in future growth by investing in our people, in innovative digital assets, and when appropriate, bolt-on acquisitions in higher margin adjacent markets. We have completed 4 acquisitions since 2021, delivering annualized revenues of £124 million at acquisition, and we also continue to make operational investments, such as the Water Operations Centre and manufacturing facility in Paisley, that supports our higher margin specialist services strategy. Where acquisition opportunities do arise within our pipeline, we will assess these opportunities in line with our clear strategic priorities and agreed capital allocation thresholds. We have previously stated that our targets do not rely on acquisitions and are deliverable organically. Our strong balance sheet also gives us confidence that we can continue to pay a growing and sustainable dividend covered by EPS at 1.8 times, in line with the policy implemented in 2023. Where we have excess cash and it makes the right financial sense, we will return it through special dividends or share buybacks, as we've done in the recent past and as we are announcing today. Over the last 5 years, we will have returned £108 million to shareholders in the form of standard and special dividends and through our free share buyback programs. And this equates to roughly 1/4 of our current market capitalisation in the last 5 years. Our rigour in capital allocation decisions is only matched by our disciplined risk management and contract selection framework, and we recognise both of these are crucial to our wider stakeholder communities. In summary, 2025 has been another year of wide-ranging progress for the group. A year where we grew revenue and margins to deliver our 2026 margin target 1 year early, delivered strong cash conversion, and reported a record order book for the future. As Bill stated earlier, it is the 5th consecutive year of revenue and profit growth, delivering both strong growth CAGRs since 2021 and TSR of circa 350% over the same period. Moving into 2026, we expect to make continued progress, and we are confident in delivering another year of margin expansion and increased profitability, in line with the required trajectory to get to our 2030 targets. We continue to believe there is a simple and compelling story of sustainable returns generation through to 2030, based on the disciplined delivery of our proven model in our attractive chosen sectors. Bill will now take you through the operational side of this strategy in more detail. Bill, back to you.
Thanks, Chris. Here's a photo of our Woodham Academy project in County Durham for the Department of Education, another successful project in our education portfolio. This slide shows the philosophy of how we run our business. We start with the core of the company, our 4,300 excellent people. We have a culture of discipline and risk awareness, supported by good processes and aligned incentive mechanisms. Being selective about the work we take on leads to a high-quality order book, which we can deliver reliably and which underpins our margin targets. Most of our order book is in long-term frameworks with repeat clients, and so we get good visibility of the forward order book and can align our people and our supply chain accordingly. This leads to a good operating performance, which further strengthens our already strong balance sheet. On the right-hand side of the slide, we have disciplined risk management processes at the pre-construction stage, and once in contract, we have robust commercial and project controls and a regular system of cross-business peer reviews and project health checks. We're targeting revenues of at least £2.2 billion and an operating margin of 4% in 2030. As I said earlier, we're very pleased that our target of 3% operating margin in 2026 as a waypoint en route to that 4% has been achieved a year early. The précis of our strategy is shown on the top of the slide. We continue to grow revenue and margin in our 3 big operating businesses of building, highways and environment, and the outlook very strongly supports this. We grow our specialist higher margin businesses in adjacent markets, both organically and through further bolt-on acquisitions, and are making good progress. In the year, we've set up our third fabrication facility in Yorkshire, following the Paisley facility which we opened last year. This new facility will also have the capability of producing pipe specials, which are in high demand across the water industry, and is a good example of further organic growth in the business. We re-enter the affordable homes market and are continuing to secure places on the main frameworks in this sector. Please remember that our definition of this market is mid-rise blocks of flats for registered providers and local councils. Finally, we leverage our geographical framework and client footprint across the whole of the UK, selling more GT services to existing customers and sectors. The higher margin specialist businesses augment the margins in our core business to produce the 4% in 2030 target, continuing our trajectory of growing shareholder returns over the long term. This slide is to explain in more detail how we will progress from 3 to 4% adjusted operating margin. There are four main drivers of our margin progression, as you see here. Firstly, growing the business and getting the efficiencies and overhead leverage that comes with that. Secondly, a better contracting environment with more equitable, sustainable contracting terms and conditions. Thirdly, the operational efficiencies we get through better use of digital tools, off-site manufacture, and the associated improved quality and reduced cost of rework, which comes with that. And finally, higher margin work through our specialist businesses and affordable homes. I'll go through each one of these in a bit more detail. There continues to be robust long-term demand across all of our sectors, driven by ageing social and economic infrastructure, which needs to be repaired, improved and replaced to cater for a growing population, the effects of climate change, and to underpin and enhance the UK's productivity. We have leading positions in the sectors and frameworks that are responding to these challenges and see a solid pipeline of opportunity well into the future, with Galliford Try part of the solution. All of our sectors are underpinned by the government's growth priorities and capital spending allocations. Our excellent position in frameworks gives us long-term access to these markets. You can see on this slide the enormous programs of work across the public and regulated sectors in which we work. The key thing here is that all of the public sector spend supports the government's growth agenda and is funded from CapEx budgets. We welcome the visibility that the government's 10-year infrastructure plan brings, and we're very confident of the market going forward. I get out and about in our sites whenever I can, and every time I look at the existing infrastructure across all of these sectors, I'm struck by the enormous market to maintain, refurbish and replace these assets. We have an excellent order book at £4.1 billion, up £300 million on the same period last year. We came into the current financial year with 92% work secured and 93% repeat clients. Chris took you through the building and infrastructure order books in more detail earlier on, so the important thing for me to point out on this slide is the 75% of work already secured for full year 27. This is the best position we've ever had looking forward and demonstrates the points I've made on the amount of opportunity out there in the market. Full year 27 and 28 already look very strong and supportive of our 2030 strategy. These are the frameworks we have at the moment, and you can see the excellent forward visibility of work that we get through our framework positions across all of the sectors. We expect a high renewal success ratio as frameworks end and are reprocured, which is represented in the lighter colour to the right. We target frameworks for this excellent long-term visibility and the ability to have long-term collaborative relationships with our clients, in which we can continuously improve our offering, our service to our clients in a sensible risk environment. I've repeatedly said that investors should be encouraged by the fundamental improvement in industry procurement methods by public, regulated and private clients. The construction playbook in particular has driven a more mature, sustainable contracting environment with an emphasis on quality over price and an equitable allocation of risk. The combination of this more mature attitude to client procurement, allied to strong risk management, helps us to drive margins in the right direction. You can see on the left that 99% of our order book comes through some form of negotiated route, be it two-stage, target cost reimbursable, or direct negotiated work. This slide shows the benefits of early contractor involvement in a project. The top of the slide shows the old-style model of contracting, in which the contract had very little or no input into the design, and after some sort of pre-qualification exercise, the bid would land on your desk and you'd have a really short period to tender the work before winning or losing it. The bottom of the slide shows what is now the norm with most clients. We get appointed and involved at a very much earlier stage in the process, where we can bring our expertise to bear on the project scope and to design the project to be efficient and safe to build and maintain, which significantly de-risks the whole process for all parties. As I've already mentioned, the left-hand boxes remain the mainstay of margin growth. Then there are a host of operational and process efficiencies which work together to further enhance our margins. Modern methods of construction, off-site manufacture, and digital tools that allow us to construct a project in virtual reality and identify improvements, which then improves the quality, safety, and efficiency of the physical build. On the right-hand side, our work mix will change over time, with a higher proportion of higher margin work, and the continued growth of the business will make the overhead more efficient. Here's a video of our Galliford Crescent project in Cardiff to demonstrate to you how these things come together to produce really good quality, safe, profitable contracts. Our teams make it look easy, but we shouldn't underestimate the enormous attention to detail and meticulous design, planning, and expediting that underpins this whole approach to building, which is just as applicable to other sectors such as single living accommodation for the military and prisons. Line of PRS projects following on from Galliford Crescent, and as you can see here, we are preferred bidder on 4 further schemes, 2 in Milton Keynes, 1 in Nottingham, and 1 in Leicester, with a total gross development value of £360 million. We are through to planning permission on the Grafton Gate scheme, with the other 3 projects due to follow, and a further pipeline of 8 prospective schemes. We've been working with all the UK's major water companies for an average of 18 years and have an unparalleled overview of the water industry in the UK through our 55 current frameworks. The photo you see bottom left is Shield Hall, which is a large wastewater treatment works just outside Glasgow. I was there a few weeks ago, and you can see in the photo 2 back-to-back Lintott panels that we designed, built and installed. These panels are huge, something like 20 metres long, and this is a really good example of how we're replacing aged control infrastructure with new controlled infrastructure, a requirement which is replicated across the country. Here you can see that, as with the main design and build part of the business, we've built a really firm foundation of long-term frameworks to support our growth aspirations in higher margin work in capital maintenance, water technologies, FM, security of national critical infrastructure, and affordable homes. And this strong framework base will stand us in good stead as we grow the higher margin specialist businesses. So I hope that gives you better granularity as to how we move from 3 to 4% operating margin through a combination of volume and leverage, a better, more mature contracting environment, operational improvements through digital off-site manufacture and so on, and then growth in revenue of higher margin specialist work and affordable homes. In summary then, we've had another really good year and are pleased to have achieved our 3% operating margin a year ahead of programme. We're in very good shape with a strong balance sheet, growing high-quality order book, no debt and no pension fund liabilities. The outlook for the future is good, with strong government and regulated demand in our chosen sectors, which gives us a high degree of confidence in the outlook through to 2030, and the confidence, of course, to announce our 3rd share buyback as we continue to grow value for Galliford Try shareholders. We have momentum in the business, and my thanks goes to our 4,300 excellent people and our supply chain partners for their contribution to the strong set of results. That concludes the presentation, and I'll hand back to the operator to take any questions. Thank you.
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star 1 on your telephone keypad. We'll pause for a brief moment. Thank you. We'll now take our first question from Andrew Nussey of Peel Hunt. Your line is open. Please go ahead.
Hi, yes. Good morning, Bill and Chris. Couple of questions, if I may. First of all, on the highways side, Bill, can you just remind us of the mix of business between local authority and national highways? And allied to that, obviously with RIS3 coming up next year, just any insight that you think or you might be receiving in terms of what that might look like for Galliford. And secondly, on modern methods of construction, obviously you referenced, or the video referenced lower cost. Is that lower absolute build cost or lower whole life cost? And equally from a Galliford perspective, obviously supportive of improved margin, but can the overall value still be developed on these modern methods of construction type programs, please?
Okay, thanks, Andrew. Over the last few years, we've been changing the nature of the highways order book, so it reflects broadly 50-50 national highways and local authority highways, which of course are spread all over the country. In addition to that, we're seeing a few other markets like energy, for example, coming in, and housing, where you need access roads into new nuclear power plants, for example, or new wind farms, or new housing development. So we are diversifying the type of clients and the type of work we do within the highway sector. On RIS 3 itself, we see the nature of the work changing in RIS 3 to more to smaller schemes, pinch points, junction improvements, things like that, resurfacing of concrete roads, things like that, which is really right up our street. So the type of work in RIS 3 will be very, very well aligned to what we do here at Galliford Try. And actually, our order book in highways is I'd say full for the next 2.5 years as we speak. On modern methods of construction, in terms of whole life of build cost efficiencies, it's both, I think, Andrew. So as you saw in the video there, we spend a lot of time designing a building that's easy to build, straightforward to build, and therefore hopefully more profitable to build, and of course to maintain, because we'll build a thing in 2 years or so, but it's going to be there for many, many years thereafter. So the long-term maintenance costs are really important, and we design those efficiencies into our buildings so our clients get the benefit of that through the whole life of the job. So the short answer is the sort of approach to building affects profitability and quality in the build stage and long-term efficiency and maintenance.
Got it. Great. Thank you.
Thank you. And we'll now take our next question from Joe Brent of Panmure Liberum. Please go ahead. Your line is open.
Good morning.
Morning, Joe.
2 questions, if I may. Firstly, can you update us on your thinking on your guardrails in respect of capital allocation? And secondly, as part of your capital allocation, you mentioned acquisitions. Could you give us an update on what that pipeline looks like?
Yeah, thanks, Joe. I'll probably take them in the other order, actually. So, as we said in the presentation, we do have a pipeline. We are building that and are slightly more front-footed on that. And as you'll see in the appendix, as we said before, we've got clear strategic thresholds and financial thresholds. So, we screen things before they go on the list to make sure they're absolutely in the spaces and the type of deals we want to do. Of course, then you have to do the DD, and the vendors have to be ready to sell. So it takes a little bit of time for that to come through. And as we go through the DD, we'll work out whether we like it or not and whether it will make a return. So, we've got a clear view of what we'll do there, and we have a pipeline indeed. On the guardrails, we've long said, as we grow the business, without growing the average job size as it goes, as we grow the business, we think that we will lower the guardrails. The guardrails are based on revenue. As we grow the revenue, therefore, the implicit answer is that the amount of cash goes up. But we don't see risk increasing, and therefore we think we'll lower those over the next 12 months.
Thank you.
We'll now take our next question from Edward Prest of Berenberg. Please go ahead.
Hello, morning. Thank you both for the presentation this morning. I've got 3, I think, please. Firstly, in relation to margins, you're expecting to hit your 4% target for 2030. How do you expect this to pan out? Do you expect a reasonably linear progression through to 2030, or are there sort of lumps in the way? I'm thinking potentially margin uptick with AMP8 or as adjacent services come through. Just be interested to see how you see that panning out. Secondly, on order book, obviously you're at the moment well diversified between sectors and contracts. That's a clear strength in terms of allocating, in terms of exposure to anything in particular. With the pipeline as you see it coming through and the opportunities available, is it reasonable that this stays very well diversified? I'm sort of wondering if water risks becoming a too large a share. And then thirdly, on affordable housing, we obviously very recently have a new housing minister, and it's possibly too early to say, but has there been any change in tone from government since he took office? Thank you.
Okay, if Chris takes the first one, I'll take the second too.
Yeah. Morning, Ed. Thank you for the question on margins. Yeah, so Bill's laid out the building blocks in his section on the presentation this morning. And if I take you back to the Capital Markets Day that we did sort of 18 months ago, we said that it would be slightly tail-ended, so there would be a little bit of a faster rise at the end. That was driven by the fostering of our specialist services, higher margin businesses, and as we build those to scale, then the mix impact of those on the overall number. As we've also said, we're a little bit ahead of target, hitting the 3% margin 1 year early. That by definition sort of flattens that's the curve a little bit. So we continue to make progress. We said we expect margin expansion in 2026. So we think we'll continue to make margin improvements year on year, but it still remains a little bit faster rise towards the end of the period as those specialist businesses come through.
Okay, thanks, Chris. On the order book, Ed, and the share of water, well, what we've seen over the last few years is infrastructure growing faster than the building part of the business. Building is around figure, I think 52% of revenue this year, and infrastructure 48%. It'll probably carry on evening up over the next year, 18 months, I suppose. And a bit further into the future, infrastructure will probably mildly overtake building. So we do see that moving slightly as we go forward. But we'll make sure that we maintain a very diversified portfolio. We're not going to become over-reliant on any one sector. And whilst water is a huge market and will grow, we will operate within the sensible bounds. We won't bite off more than we can chew. So we will manage the order book to make sure we maintain that very healthy diversity that's stood us in good stead over the last few years. On affordable housing, I think there is a subtle change of tone, Ed, although it's pretty recent. There's well-publicised issues with regards to delays through planning, delays through the building safety regulator. The funding became clearer early in the year, which was good. And I think that the logjam, I suppose, that we see currently, specifically through the building safety regulator, I think is showing signs of starting to improve. I was on a call just last week with the new head of the building safety regulator, and I was really impressed. Very pragmatic, sensible, down-to-earth person. So who's got some very clear ideas of how he can get things moving. So I do expect things to improve, and let's hope that we're correct in that. But I sense that there's improvement coming in here.
Brilliant. Thank you.
Thank you. And we'll now take our next question from Max Hayes of Cavendish. Please go ahead.
Hi guys, congrats on the results. Just two from me. So just seeing more chatter, I guess, from government on private-public partnerships. Do you see any more scope for opportunities here in your PPP portfolio? And I guess the second is, you've just seen with a lot of your peers recently temporary working capital outflows in recent results, but you haven't seemed to have this. So just wondering how you've managed that. Thank you.
Max, there's a little bit of talk about PPP coming back. It is still sort of working up in Scotland under the NPD model, and not the non-profit-based model. But there is a bit of talk coming on what I'd call lower tech type of buildings. So we're talking here about portfolios perhaps of schools or portfolios of care centres and doctor surgeries and things like that. And of course, we've been very successful in those markets before, and we still retain our team at the front end, our PFI team, who are currently involved in the more PRS front end at the moment, but are well versed in PPP. So I'd say early days, but there are a few signs that PPP might come back onto the agenda. Of course, in the water industry, it's called direct procurement, DPC, direct procurement, something like that. But it's the same thing. It's PPP in the water industry. We've not gone there yet because the current schemes are not really up our street. They're sort of enormous schemes, huge water transfer pipelines and things like that. But again, in water, there is more talk of the water companies possibly using some form of private financing to advance specific areas of their portfolios. So we will set both in terms of our track record, our team at the front end, and our balance sheet to have a look at this if it becomes reality. Yeah.
On the working capital question, I think I'd just sort of draw three things out of some of the points Bill made earlier. Whilst our order book is diversified, it also is in sectors that we know how to do and that we have long been doing. So we build projects that we know how to do. That reduces risk. And we build those projects well. And so ultimately, there's no real argument for our clients not to pay us. So I think, giving the clients no reason not to pay you is the most important thing. It is that more mature procurement environment that Bill talked about. So they recognise that stable, viable, sustainable businesses is the most important thing. So it is in their best answer for them to pay us as well. So that's an important thing. So we make sure we build those relationships. And in water, we talk about 18 years of a relationship on average. So we have long-term relationships and we do good projects. And finally, Bill referenced the incentivisation point. So our colleagues are incentivised on cash every month of the year. So there isn't a mad dash of line. They have to deliver cash every single month. And that's what they do. So the combination of those three things in our model is why we think we continue to deliver strong working capital performances.
Great, all clear. Thank you.
And we'll now take our next question from Greg Poulton of Singer Capital Markets. Please go ahead.
Morning, guys.
Hi, Greg.
Two from me, please. Could you just talk a bit on partnership housing? Could you talk a bit about the pricing environment and then specifically on affordable housing? Some reports that the central government funding is still taking a while to flow down to local authorities. Could you just talk about whether you're seeing that and how you're seeing affordable housing contracts progress in that environment?
Well, what I'd say is, we set out, as you know, Greg, we were excluded from this market following the sale of the house building business to Vistry for a few years. And as part of our strategy, which we launched in 24, it was to re-enter this market. So what we've been doing in the intervening period is getting onto quite a few frameworks that support growth in affordable housing. And we've made really good progress towards that and continue to win places on further frameworks. And then we've started to bid some schemes, which we're bidding at the moment. But you're right. So what I'd say is in our evolution, we've not been necessarily adversely affected to date, albeit that the market is slower than, or the progression, I suppose, overall is slower because of the points you make. Central government funding and some of the points I made earlier on about planning commission and the building safety regulator and so on. I do understand as well that central government funding is finding its way to the right places now. The other thing that we didn't really talk about, Greg, is that lots of the residential, the registered providers and councils and so on have been spending a lot of this funding on upgrading their buildings in terms of existing buildings, this is, in terms of fire and in terms of quality and mould and things like that, dealing with those sorts of things. And I think that is starting to tail off now, and their attention is now moving back to new build. So, as I said earlier on, it has been a bit slow. There's lots of things been in the way, but I do sense that we had a bit of a turning point, and hopefully in the next 6 months or so, we'll start to see some action.
Great, thank you.
We have no further questions in queue. I'll now hand over to Danielle for webcast questions.
Thanks, Laura. We do have a couple from the webcast. The first one coming from Stephen Rawlinson. Are there any large-scale contracts in the order book or current workload?
Thank you, Danielle, and thank you, Stephen. I think I touched on it a little bit in my answer to Joe's question earlier about the guardrails. And you can see it on the building slide that we put in the deck, sort of the average job size in building is between 19 and 20 million pounds. It's been around there for a while. It's creeping up with inflation as those costs go up slowly over time. So we've seen quite a lot of stability in that, particularly in the building sector. So no particularly big jobs there. In the environment, the jobs could be a lot smaller. So probably in the low to mid single digit millions in terms of the average jobs. In water, there are a few water plants that are bigger. And then in roads, we have highways is where we'd have the bigger projects. Our biggest project is in Carlisle. We've probably got 3 or 4 that are over 100 million, not very many. So there are only 1 or 2, and they're naturally a little bit bigger. But there's no real dependence on any one job in our revenue stream at all.
and I'd make the point that all of those big jobs are on a target cost reimbursable basis. So the risk profile of them is very different.
Thank you. Our next question is from Chris Smith. How is Galliford Try addressing the skills shortages within the industry and its impact on current and future project delivery, looking ahead to 2026 to 2030?
Okay, thanks, Colin. Well, I mean, we've been talking about this as an industry all of my career, I think. There's two things that are really important in this for me. That is to retain the existing 4,300 good people in Galliford Try, and then to bring new people into Galliford Try, obviously, to sustain our growth trajectory. On the retain side of things, we do a huge amount of work on training and career development, making sure that Galliford Try is a nice, welcoming place to work where people can advance their careers. We survey the staff every year, and really pleased this year that 87% of our people are strong advocates of the company and would recommend us as a good place to work. So we're having good success in attracting good people to Galliford Try, and we intend to become a destination employer. Our voluntary churn rate is 10.6%, which is good. And so that's where we are. And I think that our reputation, results like this, our balance sheet, are all things that attract people to good people to Galliford Try. And then through the supply chain, of course, we encourage our suppliers to recruit apprentices and more people themselves by giving them continuity. I spoke about that a little bit in the presentation. Continuity of work and opportunity to have long-term work with us, profitable work, safe work. So that does attract a good supply chain and allows them to invest, which is obviously really important to us as well. And further that, and more broadly, we support sort of the industry training schemes like CITB, and we're members of the 5% Club, which means that we undertake to employ at least 5% people in some sort of training scheme, and we actually had more than double that at the moment. I think it's 10.1% at the moment. So we do a huge amount of work here, and it's really good to get some nice feedback. If you go into, which I don't, but I get a bit of feedback occasionally from things like Glassdoor and Indeed, and websites that people use. We get good feedback as a company, which is nice to see. And in external rating agencies, we were rated number 1 for apprentices and for graduates last year. So really pleased with that. So overall, the shortages, I would say, are constant with what I've always seen, but we have to carry on working really hard to make sure that we can, have sufficient good people to sustain our growth.
Thanks, Bill. As there are no further questions on the webcast, I'll hand back to you for closing remarks.
Okay, thanks, Danielle. All right, well, thank you, everybody. Really pleased with our results, and thank you all for joining the call. And we'll see some of you on the roadshow. Thank you very much. Bye-bye.